Hey, Brian Mullins here, 1907 Investment Group. Coming today, we're going to talk about the different types of investing in real estate. There are a lot of different ways that you can invest in real estate. Some are easier, some are more difficult, but we're going to dive deep into it. So hang on and let's get started. Number one, rental properties. Rental properties are the most common thing that you probably think of when you're thinking about investing in real estate. You probably have an uncle or a family relative that has a rental property somewhere, or maybe you happen to have inherited one, or maybe you kept your old house when you moved to your new house. Rental properties are mostly single families. Sometimes you'll have like duplexes or maybe up to quadplexes. That's the most common type. So let's look at how we finance those and dive a little bit deeper into that and how you can actually get into those rental properties. So, financing rental properties. This can actually get really creative and most people don't think about it. So whenever you're talking about rental properties, you can finance them, sure, with a normal loan. You can get a conventional loan, put 20% down, and yeah, you can buy it. You can also go through a local bank and you can it's still a conventional loan, but it's more of a local loan, more of a business loan. And you can go and you can buy a house. Usually the terms are going to fluctuate because it depends on the bank, depends on the risk the bank is willing to take on. So 10, 15, 20, 25% down. This is usually not for first-time investors. These are usually for people who have a record showing that they are quite capable of finance or running a house, and so they're willing to put some financing into it. That is probably the most common way that most people think about. But there are some other ways. Let's say you've worked for someone for a very long time and you've got money saved up in your 401k. You can actually borrow against that 401k if you have enough to buy a property. So essentially you pay cash for the property, but you borrow your 401k. Another really neat idea is an IRA. So let's say you have a 401k or had a 401k, you rolled it into an IRA. So most people think with IRAs you can do stocks and bonds and all this stuff. Well, an IRA is really meant for any investment opportunity. And so you can actually take it, even if you have it in stocks and bonds now, you can move your IRA to what's called a self-directed IRA. So you take that money and you're not going to be able to get a loan with it. No one really offers loans for that. So you can't leverage it, but let's say you've got $1 million in your IRA that you've accumulated over your whole work history. Well, you take that money and you can pay cash for homes out of it. Now here's the stipulation. The money coming in for that can't be used like normal money that you would get from rental property. It has to be treated like a dividend you'd get if you owned a stock in your IRA. So you're going to have rental money coming in, it goes into your IRA. It goes into your IRA, and then you get taxed when you pull that money back out of the IRA, just like you would if you owned a stock or a bond. And it's going to depends if you do a Roth IRA or a traditional IRA. Either one of those you're going to pull from, that's going to be taxed the same way. So an IRA is a really good way to get started. You can also, have other people help you invest. You can have more than one person go in together, take out a loan. There's a lot of different avenues, but those are kind of the basics when it comes to financing your next rental property. Next, let's talk about property management. When you own a rental property, you got to take care of it. Most states, especially Oklahoma and every other state, is going to require some sort of maintenance that you're going to take care of the property for the resident. You have two choices. Either one, you can do it yourself, or two, you can hire property management. Obviously, the cheapest route is going to be to do it yourself. Whenever you do it yourself, you're responsible for everything. So maintenance, phone calls, fixing stuff, the legal requirements, because every state's going to have different legal requirements of how quick you can enter, how much notice you have to give, how to handle evictions, all that kind of stuff. So if you do management yourself, you're going to have to handle all that. Now, the truth is, if you only have one or two and you live close by, it's not that bad, it's not that hard. As you start to add more, it becomes more of a full-time job. Now, one of the most important things to remember is the tenants sometimes will try to take advantage of you if you are too nice. And it's really easy to be too nice. I can tell you from experience, it's really easy to be too nice. The second option is going to be to hire a property management company. Now, a property management company, this is our full-time job. This is what we do at 1907. We are a full-time property management company to make sure that you're taken care of and that the tenant is taken care of. So we handle all the maintenance calls. Even at 3 a.m., we answer those phone calls. We go out, we inspect the property a couple times a year to make sure that it's in good shape. We handle everything to make sure that your property is maximizing its investment and that you have happy tenants. One of our goals is to retain the tenants, because every time you change a tenant or we change a tenant, it costs money. It costs money to fix up the house, it costs money to find new tenants, advertising costs, all that stuff. So our goal is to maximize your return by retaining those tenants. So we want to keep the tenants happy. That's two things to consider whenever you are buying a property. Are you going to manage it yourself, or are you going to hire a property manager? Property manager is not that expensive, typically between $80 and $100 a month. So keep that in mind and let's move on. So the next investment opportunity we're talking about is flipping homes. So you'll see this on TV. It's really popular. It's been popular for the past 20 years or whatever. Flipping homes. So that simply means you buy a house and then you turn around and fix it up. And then you can do either one of two things. You could sell it or you could rent it out. So let's talk about flipping. Flipping is really fun, looks really glorious. The truth is it's not always that. And you might find stuff that you aren't expecting. So when it comes to flipping homes, it's important that you buy the house right, because you make your money at acquisition cost. You don't make your money when you sell it. You make your money with how much you pay for it up front. So whenever you buy a house, you're going to be looking for, are there cracks in the foundation? Are there plumbing issues? How much are you going to spend on flooring? What type of rehab are you going to do? Yes, you can make really good money flipping a house and selling it, especially in a market very similar. We're shooting this in early 2021. We very much have a seller's market. So you can, if you can buy a house cheap enough, you can most certainly turn around and sell it, because the market demands more inventory right now. Whenever you're in this type of market, it's a great way to go. Now, you could do another option. You could buy it, flip it, and then rent it out. Typically, you're not going to put as much into it because your renter market is not going to expect as much niceties, and you're not really competing against the same type of quality. So you may not have to do granite countertops, tile floors, and stuff like that. You may be able to get away with carpet and a laminate countertop, a nice looking laminate countertop. So there's a few different options here. Can either one of them work? Yes. Now, when it comes to financing, especially if you're going to hold on to it, you're either going to want to have the cash, or you're going to want to take that into account when you buy it, of how much money you're going to have to spend on the rehab, and are you going to put that into your financing. So make sure you keep that in mind. It can be very profitable. Most investors in this area are going to expect to make around $20,000 on those rehabs. Now, if you're out of state and you are interested in buying a house and then renting it out, we actually have the crews that we can go in, we can fix up the house, get it in a rentable condition, and then turn around and rent it out, and then maintain it for you as a long-term investment. So our third option are REITs. So what is a REIT? REIT is a real estate investment trust. A REIT is essentially a mutual fund. It's traded like a mutual fund. You can buy it from your financial advisor, you can buy it on the stock exchange. You can buy it, just like you would a mutual fund. So a REIT is really beneficial because you can diversify your portfolio. So there are different REITs that focus on different things. You could have a REIT that focuses on single family homes, multifamily homes. One of the more common ones that's starting to happen is retail establishments don't want to own real estate. So one that I know of here in town is Dunkin', or Dunkin' Donuts as they used to be called. They don't want to own real estate. So what they will do is they work with a REIT, and they will identify a property where they want to put a store. The REIT will come in, purchase the property, build the building, and then lease it back out to Dunkin'. So this works out really well because Dunkin' Donuts wants to focus on their one thing, which is coffee and donuts. And the REIT is focusing on their one thing, which is real estate and investing. And so Dunkin' doesn't have a huge asset sitting there that they have to maintain and control over the years. They know that they're going to be in there. They sign a long-term lease. They know how much money they're going to make. They're going to make their money on the sales of donuts and coffee. And then if they want to stay there, they can stay there, or they can tap out and leave. So it gives them a little bit more flexibility. So there's a few different ways that those REITs invest. And they will also invest in different parts of the country. So some of them will, focus on the south, some of them on the northeast, on the west. It really depends. You can look at the portfolio of the REIT and see where they're investing and what part of the country you want to be in. So how does this benefit you? Well, you get a really good diversification because you can buy multiple REITs. They're not, you don't have to spend $100,000 to buy a REIT. It's just like a mutual fund. They're shares and they're reasonably priced. So you could, buy a couple shares in a multifamily. You could buy a couple shares in a retail. You could buy a couple shares in a single family focused on the south. You can diversify your portfolio. Whereas when you're buying a house and actually holding on to it, you don't have that ability. You're having the house and it sits where it sits. So a mutual fund will allow you that diversification. They will pay you dividends typically because there's rent income coming in and they pay them out. Now, will you make as much as you would if you were investing in a normal house? The truth is no, probably not, because you're doing the management or you're hiring a management company to do the management. Whereas with a REIT they're huge, and so they're having to hire lots of people. They're having to acquire all the time. They're sitting in a nice fancy office in Miami, New York, San Francisco, somewhere like that. They're sitting in this nice fancy office. So you don't have that whenever you're investing on your own, and you're paying for that nice and the easy access. And there's also regulatory. So since these are mutual funds, they're regulated by the federal government. So that puts more of a burden on them, and they have to pay for accountants and all this stuff to meet those regulatory requirements. So is a REIT a good idea? Yes. It does help with diversification of your portfolio, but it is going to cost a little bit more. So it's a really good way to get started in real estate investing. If you really want to be in real estate, you can put money into it, and then you may want to go buy a house later and pull that money back out. So REITs can be good. How do you buy them? You buy them through the market. You buy them through a financial advisor. REITs overall are a mutual fund. So keep that in mind, and then let's look at how we diversify our portfolio. So we've looked at a few different types of investing, from buying to rent, or buying property already rented, buying to flip, and then also looking at REITs kind of on a national scale. So now let's look at what the benefit is of real estate and how to diversify your portfolio. So most people are going to have a 401k or an IRA that they set aside, and you're putting that into the stock market. Now, yes, you can get pretty creative with your stock market investments, but there's nothing really like owning a house. So with real estate, it gives you an asset that you can diversify your investment portfolio. You have a piece of real estate. It is a piece of land that you're holding on to, that you can see, that you can feel, that you can touch. If you go buy a stock of Microsoft, good luck getting a stock certificate. They don't even make it much anymore. It is a really good way to diversify your portfolio and to protect and hedge against inflation, because typically real estate is going to follow inflation, and it sometimes can outpace inflation, as we're seeing in 2021 and 2020. So it is a really good asset to own. Next, let's talk about kind of the benefit of owning real estate. This can be a benefit and a downfall, is you don't see the volatility. So whenever you are in a stock, you can pull up every day, what is Microsoft selling for today? And you can see how much money you've gained or lost. With the real estate, you can't do that, because there's millions of stocks out there of Microsoft. Whereas with real estate, there's one house, like your house, and that's it. And so there's not a stock exchange that you can go pull that number off of. You're going to have to put it on the market and see what it's really worth if you want to know. So it allows you to not worry as much. It also is a more stable asset that is there. So the benefit is you don't see and don't fret every day. The downfall is it's not going to be as easy to sell, and you don't see what it's going to sell for every day. Real estate's also a really good investment because it does continue to go up, like we talked about historically. Not always promised, and it doesn't always go up every day, every time, but overall, real estate does go up and keeps up with the market. But you have multiple revenue streams at the end of the day. You obviously have your rent. You're cash flowing every month on your rent. The second thing you have is you have your equity increase. So if you take a mortgage out on the property, every single month you are paying down that mortgage. Now, if you have it rented out, your tenant is paying down that mortgage every single month. And the third thing is you have price appreciation. That price appreciation is going to continue to go up, and you don't see it until you sell. So you're paying down the mortgage every month, the price is going up, and you're getting cash flow. So there's 3 revenue streams that you're going to make whenever you have real estate. So it's a really good asset to hold in the long term, because they do typically go up, and last I checked, we're not making any new land. So real estate is a good way to diversify and a really good investment overall. And if you need help, call us here at 1907 Investment Group. We handle everything from acquisition to rehab to managing to selling the property whenever you're ready to get out of it. So give us a call at 1907. Find us online, 1907investments.com.